I'm Steve Johnson, Farm and Ag Business Management Specialist, Iowa State University Extension and Outreach. Let's take a look at marketing tools, options. Options in the grain market are typically put options or call options. An option is the right, but not the obligation to buy or sell an underlying futures contract. You can buy put or call options. You can establish price floors or price ceilings. You must specify a strike price and a contract month, a futures contract month. Options are flexible, so you can get in and out of option contracts. And they must be purchased through a licensed broker, so you pay a premium and a commission. Option users may be either buyers or sellers of an option. Note that puts do not offset calls and calls do not offset puts. So when we use a put option, we take advantage of lower futures prices, and when we combine with a cash marketing strategy, we're protecting ourselves should futures prices move lower. With the call option, we can take advantage of higher futures prices. So if we've sold those cash bushels, we could replace those cash bushels and benefit should futures prices move higher. Let's take a look at 4 steps of store and buy a put. Let's store the crop for delivery at a later date. Buy a put option for a delivery time. In other words, we're designating a contract month as well as a strike price. Then we'll exercise the put option before delivery or let it expire out of the money. And lastly, we'll sell the commodity in the cash market and deliver. So we've protected ourselves against lower futures prices. Then we sell the cash commodity. Let's use this graphic to store and buy a put option. Since we don't know the cash price, we haven't sold the cash bushels, we'll leave this cash price open. But we'll protect the futures price by buying a put option, designating a contract month and a strike price. Therefore, we pay a commission as well as a premium. And lastly, we benefit when futures prices actually decline and futures prices fall below the strike price and we are in the money. We can exercise the put option and benefit from lower futures prices. Let's look at 3 steps of selling cash and buy a call. We're going to sell the commodity in the cash market and deliver the bushels. We'll then buy a call option with an end date and when you expect higher prices. Again, you'll have to designate a contract month and a strike price. And lastly, we'll exercise the option when the end date arrives or let it expire if out of the money. Again, we've sold the cash. We're then buying a call option. We're paying a premium and a commission, and we benefit should futures prices rise above the strike price, and that call option is in the money. We've benefited from higher futures prices even after we've made the sale of the cash bushels. I hope you found this video to be of help. I'm Steve Johnson, Farm and Ag Business Management Specialist, Iowa State University Extension and Outreach.